I'm Charles Payne, and you're watching Making Money. Hey, the stock of the day, DSW, you've heard of it, particularly you women. It's a shoe retailer. They carry everything under the sun, and yet they still provide these amazing discounts. The stock blew away the earnings, beat the street on the top and bottom line. You can see it had a great session, up 20% since I gave it to you in November. But here's the thing. More importantly, you are now seeing examples of how money is being made off of cheap gas and the cheap dollar. And I know that some of you are bored with the Fed, but how can you be bored? $4 trillion poured into the economy. Guess what? None of it landed in your bank account. Be frustrated, be angry, be bored and different? No, don't be that. Now, the question is, how will your retirement account act after tomorrow's Fed meeting? If Janet Yellen thinks this is a healthy economy, has she seen any of the most recent economic data? Think about this. Retail sales plunge, GDP plunge, consumer sentiment plunge, and then this morning, housing starts, a tremendous miss, absolutely tanking. This number right here, that is the lowest housing starts in over 2 years. I got to tell you something. I don't like the Fed. I'm fed up with the Fed, and I think you should be too. So here's the thing. I think there should be no Fed, no bailouts, no corporate welfare. If you agree with me, tweet me at CV Payne. Let's borrow the line from TD Ameritrade's commercial. Whatever, Janet. Now let's go to Nicole Petalides on the floor of the New York Stock Exchange. I want the pulse of the market to see how they really feel down there about the Fed, Nicole.
Charles, in today's Pulse of the Floor, we're doing a little something different. Did an informal survey, walked around, talked to all the traders about what they thought of the Fed. Turns out 100% of the people that we surveyed actually think the Fed was necessary. But they had tons of complaints. It's too secretive. It's too reactive. It's too much service for equity markets and not enough for our regular folks. That being said, another big complaint and another theme that we saw is that it's a political tool. Doreen Mogavero of O'Neill Securities said it. Ted Weisberg, Seaport Securities, said exactly that. So there are a lot of complaints about the Fed, but something that everybody seems to believe is that the Fed is necessary. You can't have a barter system. You can't go back to rocks as the currency. But one thing that certainly was a theme also is that we are hostage to the Fed. The last meeting is important. The next meeting is important. This meeting is important. So certainly we're all hostage to the Fed. And I don't know, maybe you could be our next Fed head. I don't even think you'd want that job, Charles Payne. That's the latest on the Pulse of the Floor. Back to you.
Nicole, that was absolutely fascinating. It's amazing to hear it. I'm not surprised they love the Fed down there, but I am surprised that they think it's too secretive. Here to help hash it all out, our investment pros. We've got the regulars, Matt McCall, Paul Schatz, Scotty Nell Hughes, looking green. You, Nicole, got the memo. Paul Dietrich's back with us. He's Fairfax Global Market CEO and CIO, and Chris Versace, Fabian Wealth Management, Thematic Growth Portfolio Manager. Can we put some acronyms or something?
Whatever you want, Charles. Whatever makes it easier for you.
Paul, you don't do that. Paul, have you ever seen Paul's official title? I'm just joking. All right, guys, let's do it. Let's dig into the first real deal. Let's talk to markets right now first because, I don't know, is there any rhyme or reason of this action of late? I actually didn't think it was a bad session, particularly NASDAQ, which climbed off the canvas, looking pretty good, Matt.
I actually thought it was a fantastic session. We bought into the Qs this morning near the lows.
The Qs, real quick, for the audience, what are the Qs?
The triple Qs basically tracks the NASDAQ 100, so about 17% of that ETF is going to be an Apple. So it's basically, I'm buying an Apple.
So you're buying the quality names on the NASDAQ, primarily the best tech names.
All the big names, the mega caps, the Intels of the world, Qualcomm's, and they're all in the top holdings. But I believe the NASDAQ will get back above that 5,000, hit a new all-time high. The action was very good in the tech sector as a whole, obviously led by Apple. But I like the way we bounced off the lows. We sold off a little bit in the last 30 minutes, but that's ahead of the Fed. I love the action.
I saw a lot of those NASDAQ names come off the bottom early in the session. I think it was a good sign. What did you think about it, Paul?
Well, I still think that if you look at almost any metric, the market's overvalued at the moment. And so anything what the Fed does,
it
will cause
any metric.
Just about.
Is it oversold to the degree that in the past it screamed crash, or is it just simply oversold?
No, it's just oversold, and we're going to see a pullback of some sort. It's going to be a buying opportunity. And I actually think that whatever the Fed does, we will probably have some sort of a pullback. That's the time
Let's
to buy.
take a thematic look at this thing. Chris, what's going on?
Just being here trying to help you, Charles.
All right, well, help us out here. I mean, so far, Paul's a little so-so. Matt liked the action. I like the action. Where do you fall in?
Well, I have a long-term view when I invest for the thematic growth portfolio. We look at all these intersections, economics, demographics, tech, and all this stuff. And, the last 3 weeks, we've seen the market pull back, but to Paul's point, you look at the S&P 500, closed today 17.3 times on earnings that are going to grow 2.4% this year. And remember, that's not even factoring in the impact of all the buybacks that we're seeing. So net income growth is a lot lower. I'm concerned about earnings.
Although let's also say this, though, Paul. When we lump those in, we're lumping in the oil sector, which is under a tremendous amount of pressure. We're lumping in the fact that the dollar is also having a negative impact. So although it's kind of frightening to think that earnings per share estimates are crashing and the market's going up, there are some mitigating factors in that story as well.
So I would argue that earnings estimates are not crashing. This is typical for this time of year.
So first quarter, second quarter are substantially lower than the Street thought they would be just a few months ago.
That's right.
And then let's not forget, Bank of Japan, let's not forget the ECB, the global central banks are putting a torrent of money in the system. The dollar rallying, I think, longer term is going to cause this massive capital flow into the United States, into large caps. And the oil thing has been a quasi-tax cut for the consumer.
A very smart person I know recently told me he was bored with the Fed, and I was shocked when he said that. Scotty, this impacts Main Street one way or the other now. Even though a torrent of money is going in, I don't think that this torrent has helped Main Street in America. Student loans are up, yeah, because the government's behind them. Auto loans are up, yeah, because they're subprime and 7-year loans. Let's talk about the politicalization of the Fed and maybe some of the pros and cons for Main Street.
Definitely pros and cons. Whether you like Bernanke, whether you like Greenspan, whether you like these guys, you have to say they did not wear their politics on their sleeve. Janet Yellen, from day one, has been obviously a wing of the Obama administration, and everybody sees it. Yes, just recently she met with 21 conservative financial leaders, but that was only after she was passed during a House subcommittee meeting for meeting with the Democrat financial leaders.
And that was a pretty acrimonious part in the last testimony. Here's the thing, though. Do you think she can draw the line? I mean, I don't remember ever hearing a Fed person talk about income inequality. I was a little shocked when she brought that up really immediately into her tenure at this job, and I wonder what can she do with respect to Fed policy to even change that, because a lot of people say, hey, Janet, you're making it worse.
Well, if she's going to sit there and bring in income inequality, she also needs to talk about all the other inequalities, and can the Fed should they really be getting involved in that? I don't think it's possible, unlike anyone else. She also brought in college loans with that and talking about inequality in the distribution of loans. These are not things that the Fed needs to be concerned about.
She's not trying to be political here. It's a fact, unfortunately. I hate to admit it. There's major income inequality here, and as a Fed president, she has to mention it when she does these testimonies. She has to ask the question. She has to mention it because it's a major issue in our economy.
But the bigger picture is this is not the Arthur Burns Fed of the 70s or from the 60s.
I thought he was a dancer. He was a dancer? Okay, golly.
This is the new Fed with full disclosure. They're coming out as having personalities. You may not agree with them, but this is what everybody wants. They want everyone to have an opinion. Now they do.
No, wait a minute. Do we want everyone to have the opinion? Do we want the Fed to have that kind of opinion, or do we actually want them to work on stabilizing the market?
This is an individual's opinion.
Okay, but once she takes on a role and she represents the Fed, she is a...
Well, then let's take it around the panel, Scotty. Is there anyone here who thinks that Janet Yellen's obvious left political leanings will interfere with her job at the Fed? I mean, does anyone think that it will be a determining factor when they raise rates, when they don't raise rates, or maybe how they govern the banking sector? I do think it could come into play with respect to how they govern the banking sector.
I think it could, as far as timing, because of elections coming up. There could be some timing. And I don't care if you're leaning left or leaning right as a Fed president, it will come into play at all
points. But you have to remember, though, that it's the Federal Open Market Committee that's ultimately going to vote on this, not just Janet Yellen.
Do you think that, I don't know, these guys, whoever's in charge seems to really have total control? I mean, I know there's a lot of members, but it feels, I got to tell you something. It was really interesting. I remember back in the day when they used to have these meetings, and Maxine Waters used to give Ben Bernanke and Alan Greenspan fits. She'd ask him, like, what's up with the food stamp program? and you can see Alan Greenspan, like, that's not really my job, but I'll check on it. And while you're at it, what's going on with all them red lights in my district? I need someone to get on that right now.
Well, the problem is that we're listening to all this crazy, I mean, all the stuff that she talks about. She gets asked these questions, and I agree with Matt. What are you going to do?
But she volunteered the income inequality thing in a speech separate from that.
That's true. But she's made it very clear that they have 3 criteria for raising rates. One is employment, and that's going up. The other one is wages, and that's going down. The other one is inflation. They're not even near their target, and it's why I believe that even though they may take away the patient rating, they're not going to raise rates.
Later in the show, guys, at the end of the show, we're going to handicap all of this for you, tell you what stocks you probably should be in, and we'll get everyone's assessment on whether they get rid of patients. But coming up right now, forget about these triple-digit moves. What about a 4-digit move? Which way is it going to be? The Dow's next 1,000 points. We're going to look at the charts to help us tell you when and how that's going to happen. You don't want to miss it. We're here to make you money. Back in 3 minutes. All right, guys, I got to blow the whistle here, open up a page from Payne's investment playbook. I want to take a technical look at the Dow Jones Industrial Average because this recent back and forth has got a lot of people worried. A lot of people are anxious about this. I want to put it all into perspective, and let's handicap where the market's going to go. Where's the Dow going to go? The next 1,000 points using the charts. First, let's start with the long-term chart, right? Because this would seem to suggest that this rally could be very similar to the one that began right in 1982. Dow was about a little bit above 1900, rallied and rallied. Of course, you got a few dips here and there, but look where this thing went. 15,000 by January of 2000. That is an amazing wealth creation machine right there. Now, more recently, well, we've had this thing where the Dow's been trading in range. I don't know. I'm going to be honest with you. To me, this is chart porn. It's just straight up. It's just beautiful. It's just smooth. It's amazing. People really loved it, but the problem is investors have become complacent because of this. And of course, last year, what we saw, just like clockwork, buying that V-shaped bottom, it was easy money. Every time we hit a V bottom, buy, pull a trigger, make money, 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 buy, pull a trigger, make money. But now the Dow and a lot of these other indices are moving sideways. They're in this tight range. We find some buyers on weakness. We find some sellers into the upside, but people are getting a little worried. It's not as easy as it was. But having said that, guys, the real deal is, I got to be honest, my work does begin first and foremost with fundamental research. The fundamentals tell me what I want to own, but the charts tell me when I want to pull the trigger. What do you think about the charts? What do you think about this market looking at the charts and the anxiety that it reflects?
So first of all, I don't see any anxiety at all. I mean, and 2 weeks ago,
So out of 10 sessions, 8 triple-digit moves, up 300, down 300, that's not anxiety?
But the percentage moves, because we're at a little under 18,000, are so much smaller than they were when the Dow is half that. And I think anxiety comes during periods of great distress. There's been more V bottoms since 2012, 3 years, than in the entire history of the market combined. This is what we're living is very, very, very unusual. And it will continue for the rest of this bull market.
Okay, but then that's the question, though, because sometimes the way the market trades impacts the market. In other words, selling begets selling. Mm-hmm. Anxiety builds. It doesn't necessarily appear overnight unless it's a major news event, but it builds on this kind of thing. It builds on the maybe innocuous triple-digit moves in your point of mind, but the 100-point moves become 200-point moves, become 300-point moves, and they do matter, Chris. At some point, it does impact investors. The average hold is 6 months as opposed to 4 or 5 years a long time ago.
Yeah, that's absolutely true. You know, that's why we have to look at the charts. We got to look at the fundamentals, as you said, Charles. And I'm sitting here looking at what's coming. You know, we got the Fed meeting tomorrow. We've got earnings season coming up. We're entering the quiet period. We've got a lot of negative news on the economy, and I think we're going to see a number of pre-announcements that's going to spook people all over again.
Well, hold on one second. Matt is the chartist here. Matt, I mean, you're the chart expert. You see that chart. It's been a beautiful thing, but it feels like we're at a point where it's going to make a big move one way or the other.
Yep. And just to follow up on an anxious comment you made, I do think we're anxious, not to the tune of 20% pullbacks, but the reason we have V-shape is because we fall quickly because we're anxious that the market's going to fall apart. But when it drops, we're anxious to get back in, that we're going to miss that big next rally. To me, this will continue, this pattern, which is a perfect pattern for a bull market. But real quick, on that long-term chart you showed, Charles, we trade in like 16 to 18-year cycles. We just started a new 16-year cycle in 2014. If we go back 66 to 82, the market was flat. From 1930 to 1948, market's flat. And there's other in-betweens, up 385%, up 1,200%. We're only up 26% in this news cycle. To me, big upside next 10 years.
But Charles, I have a question listening to how Matt just explained it. Does this not mean that these highs and upper highs and high lows makes it a healthy market? And the anxiety is a little bit healthy?
Well, anxiety is healthy. I think even pullbacks are healthy. I mean, that's an old Wall Street saying. That's an old Wall Street axiom, Paul. Everyone says, hey, the periodic correction, Scotty, to your point, would you think a 20% pullback would be healthy?
I think a 10 or 15% pullback would be healthy. And I think what people
But you stop short at 20.
20, if it's over 20%, let's face it, we're in a bear market recession. And we have never had a bear market recession when the economy is expanding. And I know we all would like it to expand faster, but it is expanding. And so people have got to get rid of the noise. One of the things that's happening is that the charts are moving based on politics and noise. It's not based on real economic. That's what's so frustrating, and that's what investors have to understand,
Right.
that when it's Fed reports, it's Greece and stuff like that, this stuff's going to bounce, and it's going to bounce back, and you got to
Opportunity,
filter
though.
out the noise. It is
Creates opportunity.
Well, it's a lot like Groundhog Day.
this.
You know, we're trapped in this cycle between Fed meetings,
Right.
and what is the Fed going to say? Are they going to raise? Are they not going to raise?
Right.
What's the data? And that gives you your opportunity.
We're 45 months since our last just 10% correction. That's hard to believe. That's almost unprecedented. We're getting to that point where it's stretched, but I still think any weakness can be bought. Dow's headed north 20,000.
All right.
Exactly.
All right, so let's do this. I think the next 1,000 points move in the Dow's up 1,000. Anyone think it might be down 1,000 points?
No.
Oh, we got to get more bears on it. Let's talk
buy some puts.
let's talk about beautiful charts. I want you guys to tell me what you think a great chart. Something on the cusp of a breakout or it's already broken out might be good for our viewers. What do you like?
I love Apple, and I tried to find a small stock, but this doesn't get any better. I buy stocks when they
You
hit
would
new
chase
highs.
Apple here.
When it hit highs and pulled back, it pulled 9% back from the all-time high, which is a perfect pullback, bounced right off the moving average, bounced right off price support. I was buying QQQs today because of Apple bouncing.
The company I really like is Elan Partners. It's a refinery. It got hit because it was in the oil industry. It's making more profits now than it was before.
What's the symbol, Paul?
ALW.
We'll get it before the show's over.
But the thing is,
ALDW.
ALDW.
Okay.
It has a 9 PE, 103% return on equity. All of its earnings are being revised up.
Are you
It's the
worried,
best
though,
stuff.
because we've been talking these oil names, and I like refineries because I think they're positioned well, but the value trap that, these PEs are getting low, and all these traditional valuations are getting low, but I kind of worry about that a little bit. Not long term. I think most of these oil names, I am worried about Whiting, which is one of the names I have pounded the table on, and we are getting crushed in that. I'm starting to worry about that, but most of these big oil names are going to be fine. What do you like, Chris?
I like Kraft Foods, believe it or not, KRFT.
No way.
Yeah,
Macaroni and cheese.
Mac
Are
and
you
cheese,
serious?
bacon, you bet you,
The
Charles.
millennials eat mac and cheese?
Here's the deal.
Scotty?
Yeah, definitely, of course, down south. That's all we got.
Well, yeah, I forgot about
Barbecue.
Barbecue.
And some hush puppies.
Here's the deal on that, right? When you look at all their key ingredients, pork, sugar, corn, and a few others, cheese, all those prices
Right.
are down huge year over year, and they've taken price
Real quick,
increases
Paul,
last
I
year.
need yours.
Mylan, we loved healthcare and biotech coming into the year. We got a takeover story with Teva. Baby boomers are going. Even Obamacare is going to push for obviously cheaper drugs. All the ingredients are there. The stock's stretched, but I think it's going higher.
MYL, been in the rumor mill for a long time. It looks like it's going to finally happen too. I mean, that's not the main reason you buy, but it is a good thing to have.
It's a little
Right.
icing on the cake.
Hey, guys, it's paramount that you teach your kids about investing sooner or later. Although most school contests, I do feel like it's like playing the Final Four brackets. It's like, what's the hot stock for the next 30 days? It is a step in the right direction. We're going to help you, take it from there as parents, and we'll be back in 3 minutes to help you and your kids.
I've been fooled before, wouldn't like to get my love caught in the slamming door. How about some information, please?
All right, guys, love this part of the show. Now, I got a tweet from a viewer over the weekend from Family Value said, my son is playing a school stock trading game. What's good for short-term gain over 30 days? I got to tell you, I really do love this tweet. But, of course, it will come from someone with the handle Family Values. Now, here's the quandary with these stock market games. It's already become, in my mind, the stock market itself, so unnecessarily short-term. We were just talking about that a moment ago. And the notion that these shifts from quick fixes, it should be about long-term wealth building. But having said that, for the next 30 days, I'm going to go back to Mobileye for me personally. I love the way it's acting the last couple of days. It was down this morning, ended up higher, almost $1. Acts like it wants to go up. I think maybe you can get a 10% gain over the next 30 days and win this contest. But try to stick with your kids, guys, beyond these contests. Have them look at more than one name, even if they've got to submit one to the school, and have them continue to follow it. And from time to time, actually buy it for them. Buy them a couple of shares. You go to DSW, buy the stock. You buy them Under Armour, buy them a couple of stocks. Start building that portfolio because besides the game, guys, I think this will help a lot. What do you guys think?
Well, I think it's all about buying what you know. And, if your kids are out there, if they're buying Under Armour, they're buying Nike, they're going to gravitate towards that. They're going to want to learn more about it.
But what about the idea, though, Scotty, that the kid's first introduction to the stock market is almost about, hey, the quick hit. a quick win.
Because that's how it is today. That's, I mean, they get their dinner through a drive-through. They get on computer games and they do a quick win. That's just how they are. You know, if you don't follow Charles on Twitter, you're missing out. Because this weekend I tweeted you, we went into Dick's Sporting Goods and my son goes, you know, before I buy anything, how's Under Armour stock doing? Before he tried on shoes. I'm like, okay, we've been watching Making Money, obviously. But that's it. They do want that quick pick, but they have to relate to it. This generation has to relate to it and touch it, feel it, and then they'll buy it.
I used to teach a class at local high schools, and I was shocked how many high school kids had no idea who were wearing Gap jeans and Nike sneakers, that they actually were owned by companies that traded stock and they could own shares in that. I think it's great for education. It teaches some kind of core, financial value.
Let me tell you, any school that is teaching these kids to be day traders and working on this is gambling. This is not investing.
But to Scotty's point, though, Paul, do you think it's they're making a compromise with respect to how these kids think, their short-term nature, and plus, it's going to be summer soon. Like, you know, maybe get them in and get them out, get them excited about it.
Use the Peter Lynch method of, you know, just exactly what Scotty said, where you shop, you buy. If you buy Disney products, buy Disney, these sorts of things. But this 30 days of what's going to go up in the next 30 days, this is gambling, pure and simple. Yeah. This is not investing.
But it's all about getting them on a Yahoo Finance and pulling up a symbol and seeing what it does, how much money they're making, and then starting to follow it. I agree that 30 days is very difficult, but as long as they're pulling it up, putting it on a smartphone, I'm okay.
Having said, anyone got a tip for them?
VDSI, Vasco Data Security.
VDSI, it got hit on a good earnings report. Looks like it formed some support around 2021. That's Matt's pick for you. All right, guys, cheap gas and a strong dollar really starting to show up on Main Street right now. The good news is I've given you a lot of these names already ahead of time. You better have some of them in your portfolio. But when we come back, we'll have even more names for you because we're here to make you money. Next.
I don't care too much for money. Money can buy me love. Can buy me love. Everybody does me so. Can buy me love. No, 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 no.
So at the top of the show, I said DSW is a stock of the day. If that's the case, Burlington Coal Factory is certainly giving it a run as stock of the week. Of course, this stock has been on fire for years. It's been a huge winner. And the only disappointing thing is I bet that 99% of the people who shop here do not own the stock. Now, I personally can thank my mom. She turned me on to this store a long time ago, even though my son and my nephews and my godsons, they all drew the line a few years ago. No, we don't want anything else from Burlington. Here's the problem, okay? They insisted that I spend $100 more for this shirt, right? The polo shirt with the big logo as opposed to the polo shirt with the small logo. I'm in a position I was able to do that, but most Americans aren't, and this is why Burlington has been a huge, huge winner. Now, the moral of the story is take your mom shopping, and she will reward you with great investment advice. All right, guys, let's discuss this thing because the lower end of retail has been absolutely on fire. I know there are a lot of pros and cons to a whole lot of things, and maybe to a certain degree it reflects still anxiety amongst average people. But Paul, you know, it's hard to argue with those charts that we're seeing and the numbers that we're getting from these companies.
Yeah, I love this space, and I've always believed that it would take a little bit of time when the gas prices went lower, that stuff would start filtering through the retail space. There's only two things you can do with all that money you're saving at the pump. You can either spend it or you can save it. Both of those are good things for the economy, but I believe more and more you're going to see, especially in the spring, retail sales, retail stocks going up.
Well, two things. One, you can't fight the charts. We just talked about the charts. The retail S&P 500 retail index, all-time high. I think this is actually a very bullish signal, in my opinion. Just like I say, all jobs, it doesn't matter if they're not good jobs, there's more jobs out there. People are spending money. The lower income bracket is spending money. They're not moving up to the mid-tier. They're spending money where they should be spending. There's more jobs out there. I think it eventually makes its way up.
But there's the nature of the stock market and investing, and this is where we can help the investors, because I got to tell you, I was in the airport yesterday, and I saw on a magazine stand, I don't know if it was Newsweek or Time or something, one of these magazines, the cover read, "Can Target get back at shoppers?" Well, the stock hit a 52 all-time high, right, today. So is the stock market now back to its traditional role as sort of a harbinger of things to come? And people have to sort of be forward-thinking and start to make these investments now as opposed to waiting later for the real evidence to materialize.
Right, so you're saying is the stock market a predictor of the economy versus or vice versa? The stock market is absolutely a predictor of the economy 3 to 9 months down the road, depending upon geopolitical events. So I agree. But the Target thing, it's fun. Where we are, Target hasn't missed a beat. People still jump into Target every moment they get. They don't go to Walmart anymore. They all go to Target now and Kohl's.
Well, is that a good thing, though? Does that mean that they've stepped it up a little bit? They feel even friskier?
Yeah, so I don't see the.
I'm feeling frisky. Let's get more.
Remember the chart pouring on it.
I can see everyone now in the truck like, Dad, you missed Walmart. Yeah, I'm feeling frisky today, baby. We're going straight to Kohl's.
Or maybe they're going to Tiffany's then. But I don't see the anxiety among the lower-end shopper. I think, to Matt's point and Paul's point, I think they're there. They're saving a tiny bit and they're spending a lot of it.
I want to go to you for Scotty, but Cheryl, one of our loyal followers, thinks that we're all too overly optimistic here. Are we missing something? I mean, you're the essence of economics, right? You control the household budget.
I think you just call me cheap. No, what we're missing is a lot of these same brands hurt themselves. They created lower-end lines that are going into these discount stores. And before, you could only buy the Polo Ralph Lauren when you went to the Polo store, the upper-end department stores. Now you can go to the TJ Maxx's, you can go to the Ross, and you get them. It might not be the same
Anecdotally,
quality.
though, are you seeing more people shopping? Are you spending more money? Are you feeling frisky?
I am seeing people more in this middle income buy more things, but they're buying, it's quantity, not necessarily quality, and that's a big thing to remember right now.
You're not going to tell us if you're frisky.
But let me just also correct one little sexist thing you said. Men might take their mother shopping. That never worked for me. My mother was much more difficult on me. I took Daddy. Daddy was a lot easier just to keep me happy.
Oh, excuse me.
There you go.
You know, the Target, too, is they're changing strategy. They're bringing in groceries and organic food and stuff like that.
We know that,
really
though. These are headline things, though. It takes a while to see if they materialize, but the point is, the stocks move up before we even see evidence that those things have worked. And I think the message for the consumer, more importantly our viewers, are if you think these things are going to work, don't wait for the numbers if you think. I mean, that's what I'm talking about.
I would say take a page out of Peter Lynch's book. Follow the kids, see where they're shopping, see where they want to go. Those are the stores.
So I'm taking Mom, she's taking Dad. You're saying follow the kids.
I'm saying follow the kids.
I think the kids are too fickle. You know what I mean? I think that's how you get stuck in American Eagle.
I don't know, Charles. You're a huge believer in Under Armour, and I got to tell you, I was at Dick's over the weekend.
As was I.
People were buying Under Armour and Under Armour and Under Armour.
And they're pushing under their ad campaign at Christmas with Santa Claus himself branding himself with Under Armour.
Was it dunking? Can he dunk?
It's just what we need, more stretch fabric in America. They're not making America more beautiful.
Here's the issue. Kids are increasingly brand conscious today.
Very much. And
they don't want to go to Target and get some,
Wait a minute, weren't they in the
brand.
80s that way as well, though? I mean, we were a very materialistic society in the 80s. Are we returning back to that?
We're not materialistic today, though. But also, don't forget, not only are we seeing it at the lower end level, but still the upper end stores are doing a really good job as well. We're seeing across the
I've been hitting some of these upper end stocks. I mean, the Tiffany's of the world feels like they struggled a little bit.
But then look at Ralph Lauren that got schnockered not too long ago.
Yeah, some of these upper end names. I mean, it feels like maybe at the bottom, it's a bottoms up sort of kind of recovery.
I think that's because out there you have the cash strapped consumer, right? We talked earlier about how there's a lack of wage growth. They do have to spend. They're looking for value. That's why I think you're seeing stores like the one you mentioned or Ross stores and others.
Are there any stores I didn't mention? Well, outside of DSW, Burlington, some other names
Marshalls?
that it's not too late to
Marshalls, maybe?
TJ Maxx.
Best Buy and Bed Bath & Beyond, these are real value stocks right now.
You picked two names that were supposed to be dead 3 years ago because of the internet boom, and now you're saying not only are they alive, but they're going to continue to do well.
And they are doing well.
Really?
Yeah.
You would buy Best Buy?
I own Best Buy and I own Bed Bath & Beyond, mainly because they're so undervalued.
It's kind of recreated. But Best Buy's done a good job of when Circuit City went out, they said, uh-oh. I think they've done a really good job recreating themselves.
Remember Circuit City, just more of a business lesson, when they decided to help the company, they would fire their best salespeople? That was after they turned down a takeover bid that was a 50% premium.
That was a mistake.
There's got to be some college course somewhere with the Circuit City management on what not to do. How to destroy a company in 2 easy steps. All right, guys, thanks a lot. Hey, guys, by the way, be sure you got to check out Strange Inheritance with Jamie Colby tonight. First, 9 p.m., Jamie talks with a family of a real estate developer, discovers his model homes were filled with furniture from a world-renowned craftsman and artist. And then at 9:30, Jamie talks to the great-great-grandson of a Confederate general, George Pickett. He was swindled out of his inheritance of Civil War artifacts. It's these two great shows. Strange Inheritance, of course, airs Monday through Thursdays, 9 p.m., right here in the Fox Business Network. Well, it's not quite Main Street hysteria, but as many people are still out of the stock market, I did get my first red flag from a hot trading driver out in Scottsdale, Arizona. Made me a little nervous and excited at the same time. I'll tell you all about it when we come back.
And now, time for Upon Further Review.
By the way, you guys are tweeting up a storm. Keep them coming. I love the conversation that you're having there. Listen, I've been saying, right, ever since this show began, that one of it's anecdotal, right? But one of the things is that I haven't seen any cab drivers trading this market between fares and red lines. Well, it sort of happened to me yesterday. And now, this wasn't a cab driver. He was one of these limousine drivers. He took me from the airport to Scottsdale. And he really, I mean, this guy was so great. He had a great energy. He professed his love for trading the market. In fact, he loves it so much that he's totally unmotivated through his regular job. So Paul Schatz, upon further review, was that my Joe Kennedy moment? You know, when the shoe shine guy came over and his overenthusiasm for the market led Joe Kennedy to sell everything just days before the crash.
That was not your Joe Kennedy moment, but it is definitely symptomatic, if this is a football game, of a bull market that's in its fourth quarter. This could last another couple of years. But
that's a long fourth quarter.
Look how long
maybe
it's
a baseball game in the third inning, no?
But what's happening is one by one, you're going to start to see this. In 1999, my trainer in the gym gave me a daily stock tip. I had a doctor who fired me because I didn't get the new eyeballs over earnings. The Wall Street Journal ran pieces on people who were owning a garage and day trading at lunch. We're just seeing the very early stages of the average person getting back in. It could last several years or more.
Right. I think that's true, Chris.
I think it is true. And I remember back in '99 when I was living here in New York, and I'd go get my bagel and stuff, and people would be asking, you know, hey, what are you buying? And asking everybody in line. We're not seeing that type of frenzied activity, but I would watch out for it.
Yeah, I don't think we're anywhere near that right now. I mean, I get more people complaining about the stock market not being in the stock market, saying it's overvalued, if anything. Probably 5 to 1, they think it's overvalued. BAML, Bank of America Merrill Lynch, came out their fund survey. More underweight in the U.S. for these managers since 2008, and 15% or 25% say U.S. stocks are overvalued, the highest in 15 years. So the fund managers, the big guys, are saying the exact opposite, which to me, that's a good thing.
I mean, I agree the market's overvalued, but anyone who's day trading today, I'm happy for them because they're going to get wiped out. Because just as we
Why are you happy for them?
Because they'll get wiped out. They should get wiped out because they're not investors.
Oh, hold
they're
on,
day
Paul.
traders.
I mean, I understand you're a tough love kind of guy, but, you know, listen, I got to tell you, so far, this is the guy's strategy. He's day trading the indices, the big macro indices, you know, the Dow, S&P, NASDAQ. The Russell is the key indice that he looks at. He thinks the Russell sets the tone. I got to tell you, he probably made money today. I know he's been making money, so... I mean, do you give him some kind of kudos for getting in there?
Look, the guy is the market is being up and down because of political stuff. He can't know that. Nobody knows that. You got to be in it for the long term.
But that's not the point. The point is he's actually getting interested in his future and trying to create a financial future for himself. Yeah, I hope he succeeds. The odds aren't good, but at least he's doing something.
He's doing it the wrong way.
But here's the thing. A lot of people are embarrassed. No offense. You guys, Wall Street can be a little intimidating. A lot of people go, you know what? I don't have enough money to go take up your time. My little $1,000 of investing is not enough. So they go to these and they day trade on their own.
Although I will say I met a lot of people just in the airport yesterday, and one guy just fired his broker because he doesn't think these brokers, these smart guys on Wall Street, know what they're doing. So I do applaud him for getting in there, and hopefully he'll have some discipline. But he was asking me in a way that I felt like he does want to take it to the next step, and he knows that maybe his luck may run out at some point. All right, the runt of the litter, because it focused on casinos in Vegas. That's right, we're talking about MGM. They're having a last laugh, at least today. It's soaring past its rivals, and I think there's still a whole lot of money to be made in the process for you and for them. All right, guys, let's get down to this and try to help make you some money. Today's stock idea is MGM Grand Resorts International. MGM is the stock symbol. Here's the deal. Up today, an activist, yeah, I'm jumping on the activist bandwagon. You can't beat him, join him. So an activist used to be an analyst at Citi, pretty great reputation in this space, Jonathan Lith, now pushing for these guys to go into a real estate investment trust. It would be a tax-free way of them transferring assets, their land assets, into this particular vehicle, also separating the casino and the lodging properties. Now, apparently, crunching the numbers, there's value anywhere from $33 to $55. 55 would be a dream, but I do think there's a lot of room to the upside. It doesn't have to be 55 bucks. Keep in mind, 18 destinations, 5 jurisdictions. They did over $10 billion in revenue last year. It's not a small company. I know we think of Vegas as sort of dying, but they're all over the world. But Vegas is where they've been smart. They do have 63,000. Here's the thing. Vegas, you got the MGM Grand, the Bellagio, the Mansion, Mandalay Bay, the Mirage. They do have a Macau presence, but it's not a Macau play like Las Vegas, Sands, or Wynn. China has been better, though. China is now 30% of revenue, 35% of cash flow. A few years ago, it was 20% and 22%. They've got the city center thing. It's been sort of considered dead on arrival in Vegas, but I've seen headlines where Vegas overbuilt starting in the 1950s. In Japan, I think they're going to be big also. This is one I would absolutely chase. Matt, what do you think?
I do like it down here at this price. And look back in history, Payne Gaming, P-E-N-N symbol, did a similar thing. Stock rose 77% since that happened. This is only up 10% today. So you may be chasing on a one-day play, but longer term, I think you could do it. Macau is obviously an issue. The first 2 months down 35% revenue over last year. But if they could spin off land, that's the only reason I'm buying it, though.
Yeah, this is a great thing. Hotels have done this forever. You know, they've spun off their management and the underlying land. And people who want to get into gambling, they want to be in gambling. People who want to get into land, they want to be in land. This makes sense.
Yeah. MGM rolls the dice?
No, so I stay at the Bellagio. No problem with that. I really enjoy it there. I don't want to own the stock. I think the REIT is unlikely to happen. I think it's a short-term story.
Why, though? Why wouldn't it happen?
I think it's people, to Matt's about Penn Gaming. I think just because it happened a couple of times, I don't think it's happening with MGM. I also think the Macau thing is a much bigger story, and I'd be a seller in any strength.
But don't you think that the land and buildings that MGM has are worth a lot more than Penn? Penn's are in a lot of rural areas around the country. I think the Macau land, the Vegas land, you can't put a price tag on that side. So if it does, it could explode.
I totally agree with you with the notion that the land is valuable, blah, blah, blah. I just don't think they're going to put it into a REIT and spin it off.
Why not?
You know, we're not involved in any of these gaming stocks, to be honest with you, but the conversion to a REIT. Now, I like REITs. In the Growth and Dividend Report newsletter, we own a bunch of them. We like the rising dividend status. So if this, gets some legs, then we'll take a look at it.
You wait, though, for the actual news to come out and still chase it, because it wouldn't be all built in the first day, no matter how much it would go up.
It could be, but you have to remember, though, they have to keep paying out their earnings. So you're going to see a rising dividend stream. And if this story goes, it's not going to be a one-day, 3-month type of deal. It's going to be a progressive deal. Yeah. That might have some interest.
I think it may happen. I think no matter what, it might actually also wake up the fact Vegas wasn't too bad last year. I mean, it was down a little bit, but it was nothing like Macau, which I think probably, in my mind, is oversold. Doesn't mean you buy the Macau names here. I think the Chinese, the people in charge, have proven a point, but that's a cash cow. I don't think they want to give up too much soon. Speaking of which, cash cows, how about the Federal Reserve? They answered to nobody, yet they created $4 trillion. And, well, let's face it, phony money if it came from nowhere, right? I'll give you the reasons why I say the Fed should not remove patience from their release, but what stocks you should own just in case they do. That's next.
And that's just what they'll do. One of these days, these boots are gonna walk all over you. Are you ready, Boots? Start walking.
80% of the poor in Africa are rural farmers. 96% of them are doing rain-fed agriculture. They're all competing with each other, all making very low margins, making enough to survive, but not enough to get out of poverty. So Kickstart designs low-cost irrigation pumps, enabling them to grow high-value crops throughout the year so you can make a lot of money. It's all very well to have a whole lot of small innovations, but unless we can scale them up to where we're talking about millions of farmers, we're not going to solve the biggest challenge. This is precisely where the kind of finance that Citi is giving us is enabling us to scale up on a much more rapid pace. When we talk to the farmers and we ask them what's the most important thing, first of all, they say we can feed our families. Second, we can send our children to school. It's really that first step that allows them to get out of poverty and, most importantly, have money left over to plan for the future they want.
Do you want to know how hard it can be to breathe with COPD? It can feel like this. COPD includes chronic bronchitis and emphysema. Spiriva is a once-daily inhaled COPD maintenance treatment that helps open my airways for a full 24 hours. Spiriva helps me breathe easier.
Spiriva Respimat does not replace rescue inhalers for sudden symptoms. Tell your doctor if you have kidney problems, glaucoma, trouble urinating, or an enlarged prostate. These may worsen with Spiriva Respimat. Discuss all medicines you take, even eye drops. If your breathing suddenly worsens, your throat or tongue swells, you get hives, vision changes, or eye pain, or problems passing urine, stop taking Spiriva Respimat and call your doctor right away. Side effects include sore throat, cough, dry mouth, and sinus infection.
Nothing can reverse COPD. Spiriva helps me breathe better.
To learn about Spiriva Respimat slow-moving mist, ask your doctor or visit spirivarespimat.com.
Obama budget, take one.
Obama's budget spends our money wisely, balances in 10 years, and fixes Obamacare.
Can't say that. It keeps Obamacare. All of it.
Right. Obama's budget spends our money wisely and balances our budget.
No, it never balances.
Obama's budget spends our money.
Nailed it. That's it. That's the one.
There's a better way. A plan that balances in 10 years and repeals Obamacare. Tell Congress, support the House Republican balanced budget plan.
The real question that needs to be asked is, what is it that we can do that is impactful?
What the cloud enables is computing to empower cancer researchers. It used to take 2 weeks to sequence and analyze a genome. With the Microsoft Cloud, we can analyze 100 per day. Whatever I can do to help compute a cure for cancer, that's what I'd like to do.
All right, guys, time now for your marching orders. Well, tomorrow, we've been talking about it. Janet Yellen probably going to take a page from that Gene Wilder character in Young Frankenstein and scream, "It's alive! It's alive!" Now, the question is, what's alive? Animal spirits? Inflation? Deflation? The U.S. economy? You know, I got to tell you, the Federal Reserve is, I guess they call it a quasi-government, quasi-private entity, but the fact of the matter is they really don't answer to anyone, yet they created $4 trillion in phony money. If they start hiking rates, will that really be sort of a final admission that all they did was save banks and fund profligate government spending? All right, guys, let's talk about this with the marching orders. Listen, there are reasons that I say the Fed should not, or probably shouldn't, remove that patience comment from the release. Wages, you brought that up, Paul, flat. Housing, a disaster. The global economy on shaky ground. The global markets, well, the stock markets are higher, but the fact of the matter is those global economies are in really bad shape. So let's talk about the true state of the economy. What's the best place to do? How do you hedge tomorrow's decision? Are you doing anything special because of the ramifications of what could happen tomorrow?
Well, I think that, nothing is going to happen tomorrow, to be quite honest. And as a result, I'm taking a look at some dividend-paying stocks that have gotten whacked ahead of this. I think that she's going to come out and she's going to say very dovish comments. The language is probably going to remove any concern about June. I think we're going to see more confirmation. It's the back half of the year. We'll see these dividend stocks rally.
Patience stays in the communique.
I think so.
Or
something similar.
Okay.
What's another word for patience? Considerable time was, I think, the word that they replaced patience. That
was 6 months.
That was 6 months, considerable time. I just think, like I said, this is deja vu all over again. There's been more analysis of what she's going to say tomorrow than what we see before the Super Bowl. Just put us out of our misery. Tell us what you're going to do, and you'll restore trust.
So you went considerable time, 6 months, patience too much, wink, wink next week?
Pretty much.
Okay. What do you think?
So, as you and I differ, I love the Fed. I love Bernanke. Not so sure about Yellen. I don't think
was
the Fed
Greenspan the maestro?
I think he was the second worst Fed chair of all time.
Okay.
Oh, wow. But listen, the dollar's gone up. It's a quasi interest rate hike to begin with. Oil's gone down. It takes the pressure off of inflation. Mm-hmm. We talked about economy. It's going to be better in the second quarter, even better in the third quarter. The Fed should not raise rates at all. Europe, Japan, et cetera, let it be.
When you say the Fed should not raise rates, are you being a selfish Wall Street guy that just likes the idea that this money has helped you? Or do you really, where's it helping Main Street? Where is it helping Main Street?
Nobody's ever called me selfish.
Well, the audience is probably calling you selfish because you don't want the Fed to get out of the way.
Listen, in 2000...
Who's going to pay for that $4 trillion when the roosters come home?
There's nothing to pay for. The Fed created it. They're paying it back to the government themselves. Organically, it will roll off the balance sheet. In 2009, Bernanke looked over the abyss and said, holy geez, IBM's not going to make payroll. GE Capital is going to go bankrupt. So I always thank God that we have Paulson and Bernanke.
Let me just say one thing. December 17th, they went from considerable time to patience. The market skyrocketed the next couple of days. So I don't care what they change it to. Market's going up tomorrow.
All right, Paul, real quick.
Yeah, this is all just noise. In the long run, we don't have inflation. Why raise rates?
All right, guys, let's leave it there. Remember, though, it is about long-term investing. And I got to tell you, we really appreciate you guys watching us every night. Catch us 6 p.m. If you can't, DVR it and tell your friends. We're really rocking and rolling. Lou Dobbs, next.